Joining me to give more life to the numbers is Tshabalala, the CEO at Standard Bank. Thank you so much for your time, Sim. I looked at your results. Thank you so much. I looked at your results and your comments. So your first comment that I saw coming out of the results was that you are hopeful that the pandemic is behind us. And for me, that stuck out because for the past 2 days, I've been reading trading updates from insurance companies, Momentum and Old Mutual, really painting a depressing picture of, increasing their pandemic reserves and talking about future COVID-19 waves. And I'm just interested in your optimism in that, saying that the worst is behind us. Does this signal that the worst is over for your business?
Well, thank you very much again, Zinati, for having us. I think our thinking is based on just the history of pandemics. I mean, we've had pandemics for 4,000 years in the world. We understand what has happened, for example, with the flu of 1918, the plague of London in the 1600s, and so forth. And they always revert to mean. So there's the concept of reversion to mean. We know that you'll have several waves, but eventually things will revert to mean. Secondly, we also know from that history that eventually a vaccine is found and that it gets proliferated. There's all evidence throughout the continent as well as in South Africa that the rollout of these vaccines is accelerated. That is not to decry, however, the fact that the impact of the pandemic is going to continue to be long-lasting, pervasive, and profound. But I think when you just look at it from a macro perspective and you look at the history of these pandemics, they will revert to mean. And we're taking a long view. So that is the perspective.
All right, I'm with you, your confidence there being underpinned by history and science. And I actually just want to zoom into your results because largely the boost has been due to base effects. Of course, we did see very muted activity in the previous comparable period. And I'm just wondering, when you see those earnings going back to pre-pandemic levels where we actually see real growth?
So let me make the following points. Firstly, what's driving our performance is growth in our balance sheet. So you saw our consumer and high net worth balance sheet grow by 10%, and our business and commercial balance sheet grow by 8%. We saw, as you correctly point out, huge activity growth in South Africa and in Africa regions. So we saw a huge number of digital transactions increasing, card acquiring increasing, and then our wholesale business writing more loans. So a longer pipeline and more loans being written. We saw momentum in the franchise of basically our retail bank, our consumer and high net worth business. We had more clients on our books, more activity. And we, saw a decline in net interest income, but that was driven by the massive declines in interest rates continent-wide. Our non-funded revenues were flat, like you say, because of base effects. Last year, we had huge trading revenues, which were not repeated this year. And then going into our costs were well managed, and then our credit charges declined as a consequence of the economic environment. And so those were the dynamics driving our performance. However, your question around when we will get back to 2019, we will be disclosing our medium-term targets and the path to those targets tomorrow during our strategic review with our shareholders. And Zinati, you are welcome to attend. And so I am doing a Dickens on you. We're keeping you suspended to make sure that you're in attendance tomorrow.
I will indeed, and I'll keep my word. But just on that, I mean, you talk about how, some part of your revenue was affected negatively by the lower interest rates environment. And I'm just wondering, where are you looking for opportunities and more growth in this current low interest rate environment?
So clearly, we believe that the loan growth that we saw during the first half of the year, particularly in the retail part of the business, is calculated to continue to grow, firstly. And so we have not repriced aggressively. We have stood by our clients, and we're relying on volume. So the growth in our net interest income is going to be driven mainly by the growth in our lending book. Secondly, in the corporate and investment banking part of the business, the old CIB, what we now call wholesale clients, that part of the business, we are seeing a great pipeline here in South Africa and on the rest of the continent. Essentially, what we are anticipating is an investment cycle that is starting to manifest itself, and it's showing up in our pipeline. Thirdly, we think that having put our infrastructure in place, we've seen greater digital activity, and that'll give rise to better client experience and therefore higher activity from our client base, which will give rise to higher fees and commissions. Next, you saw that we did a transaction with Liberty, in terms of which we're buying out the minorities. That transaction is fantastic. It's a case of 1 and 1 makes 3. Our insurance and asset management business will be bolstered by those two businesses, Standard Bank and Liberty, coming together, and that is another source of growth. And lastly, and most importantly, we have a portfolio in our group. We're seeing the effect of a portfolio. The businesses in our Africa regions are going to be growing because they are growing off a different and a lower base than South Africa. And when you put all of those things together, they give you faith in the various vectors of growth in our business.
You mentioned your digital strategy, which you have been quite aggressive on across the regions that you operate in, but I will zoom into that a little bit later. But I just want to go to another part of your results, which are the deposits in South Africa, flat compared to the previous comparable period. But in your Africa regions, actually up by 20%. And I'm just trying to understand the drivers for the differences in the deposit rates.
So, I mean, essentially, if you just think about the Standard Bank franchise, you're right, our average earning assets, which is sort of the lending part of the business, grew. And it grew as a consequence of us writing lots of retail type loans. It also grew because we have got a large deposit franchise both in South Africa and in the rest of the continent. And we were seeing a flight to quality in a number of these jurisdictions. Our business outside South Africa is traditionally, in the wholesale part of the business, both a lending and a deposit gathering business. And our activities then are driven by the confidence that clients have in placing their deposits with a Standard Bank. Our loans to deposit ratio outside South Africa is not high. So in other words, we have higher deposits than loans that we advance. And it's just a question and a consequence of the fact that people have got lots of faith in the Standard Bank franchise.
And I was actually reading through your results, and I saw that because of this digitization strategy, you're trying to rein in on the number of branches that you had, until I looked at an announcement that you've partnered up with Pick n Pay, where you plan on extending your branches there. And I'm just wondering, you are going into the space, Pick n Pay. Why Pick n Pay? Because there's already another competitor there, Time Bank. Why Pick n Pay?
So we've spoken quite a lot about the new methods of competition. We're moving into a world that is based on network theory, essentially. We believe that we are the original platform at Standard Bank. We were formed in September 1862, actually in Port Elizabeth, by wool farmers. And our job was to put together the farmers who were exporting their goods to the United Kingdom. Therefore facilitating trade. And we were therefore facilitating importers and exporters, borrowers and depositors, payers and receivers of payments. If you look at our business in Namibia, the same story. We were formed in Lüderitz in the early 1900s to facilitate the buying and selling of diamonds. That was happening on our platform. We were the ones coordinating the relationship between buyers and sellers, importers and exporters. That notion applies equally today. Our job is to put together people who are buying and selling goods, and we use whatever mechanism and whatever distribution channel is available to us. And hence, therefore, the partnership with Pick n Pay. Pick n Pay and Standard Bank have formed a partnership that will bring together these two great institutions to serve clients. Firstly. Secondly, we are going to be constructing in-store branches in some Pick n Pay stores, and this will be nationwide. A couple of these stores are currently being opened. They are small branches, they are small stores. They'll be manned by Standard Bank personnel, and they'll be there to meet the needs of consumers who are transacting and buying goods at Pick n Pay stores. It's a partnership, and it's illustrative of this modern way of competing, where you're using your strength and your relationships with other people to serve a common set of clients. We have no problems with competing either in our own distribution channels or in other people's distribution channels. That is just the nature of competition. In fact, we think competition is healthy. Right. We have the highest regard for time, but we're in competition here. We're about meeting client needs at cost acceptable to them and convenient for those clients.
All right. Now, I just want to move on to another area. Of course, we do know that financial institutions are very important in closing the inequality gap in the country. And last month we saw the unrest really highlighting that ever-widening inequality gap. And I'm just interested in your view on how the unrest has impacted the confidence of foreign investors.
Zinati, I do think that there are a couple of data points. So first of all, as a matter of fact, we had projected GDP growth for South Africa. Our base case was that it would be 4.6% for 2021. The events of early July suggest that the number will be closer to 4%. So nearly 0.5% slowdown in momentum. Secondly, we don't think that the damage is permanent. And the evidence for that is that the bond yields come back. The rand weakened, but then came back to its normal trajectory. Credit default swap spreads widened and then declined again. And so investors, and then the JSE All Share Index, for example, showed signs of stress, but has gone back to levels prior to those events. That really tells you that investors can see that South Africa is a country of laws, that it's a country that has got strong institutions, and they see through that volatility. However, the damage to physical infrastructure and the damage to people's perceptions about our ability to meet our obligations, rights and duties has been damaged. I do think, however, that ordinary South Africans are law-abiding, they stick to their obligations, and people have responded, and they've responded very, very well. The real issue, however, is what you highlight, the fact that we've got high levels of poverty and inequality, and that it is imperative for all right-thinking South Africans to make every effort in all the various sectors of South African society to address the issue of poverty and inequality and unemployment.
A very important figure in the financial sector, finance minister, and I'm just interested, do you like our new finance minister, Enoch Godongwana?
I have the highest regard for Mr. Godongwana. In his previous position, we used to interact with him as we do with all the other political parties, often disagreed with him, but I think that he is in the right zone in terms of his views about fiscal policy, monetary policy, structural reforms, etc. And I think, again, you saw the way the markets have responded. They responded well because he's orthodox.